Two major developments just happened that will shape how much we earn, spend, and feel financially in the years ahead. America's debt has entered a risky new phase. It's growing faster than the government can control. At the same time, the Federal Reserve quietly injected $13 billion into the banking system and halted its balance sheet shrinkage, a sign that easy money is back. Together, these moves hint at where the U.S. economy is headed and why Trump and Scott Bessent are planning a significant cut in interest rates. America's debt spiral reaches a dangerous point. For decades, the United States relied on a strong industrial base and the confidence of holding much of the world's gold. That era is over. Today, America's debt is expanding faster than the nation can manage. 25 years ago, national debt was around $6 trillion. Now, it's over $38 trillion, a seven-fold increase accelerated by the 2008 bailouts and emergency spending in 2020. The growth isn't linear anymore, it's turning exponential. The real danger came after interest rates spiked in 2022. Debt costs soared even without new quantitative easing. The issue lies in the existing debt. Trillions in old bonds at low rates are being replaced by new bonds at higher rates, sending annual interest payments over $1 trillion, more than defense or healthcare spending, and on track to surpass Social Security by 2030. When interest becomes the fastest growing part of the budget, the government's financial structure tilts. More money goes to bondholders, leaving less for everything else. The United States risks becoming a government primarily focused on servicing past debt. Some wonder if the U.S. could default or write off debt. That might sound easy, but it would trigger a shock far worse than the current crisis. Major creditors like China and Japan would see it as betrayal. The global bond market built around U.S. Treasuries would collapse for a generation, and Washington would lose its ability to borrow at scale. This is the backdrop for Trump and Bessent's strategy, focused on debt timing and structure. Trump and Bessent's plan: slash rates, focus on short-term debt. The growing debt pressure has led Trump and Bessent to focus on one key lever: short-term interest rates. Today, the average rate on national debt is about 3.36%. With over $37 trillion outstanding, even small changes have massive effects. Their strategy: push short-term borrowing costs down and use the window to refinance as much debt as possible cheaply. Bessent is shifting Treasury issuance towards short-term bills at an unprecedented scale. By flooding the market with 3- and 6-month notes, yields there fall, letting the government roll over large obligations at lower costs. The plan hinges on short-term Treasuries becoming the main cost control tool. Success depends on Federal Reserve cooperation. Trump has been shaping the Fed to support faster rate cuts. Key figures like Steven Mnuchin and Stephen Moore align with the plan. Potential Fed appointments hint at aggressive short-term rate cuts while maintaining calm public messaging. If Hassett or a similar dovish voice leads, the Fed could lower rates without panic. The refinancing risk constant rollover pressure. But there's a major weakness. Short-term debt must be constantly refinanced. Bills mature quickly, and every rollover tests investor confidence. If trust falters, the Treasury suddenly needs cash to pay investors unwilling to roll forward. In that case, the Fed must step in, creating new money. Classic debt monetization that instantly expands the money supply. Small rollover problems can trigger this. But imagine trillions of dollars in short-term obligations maturing in sequence. Refinancing becomes a constant pressure point, and the debt system grows sensitive to minor market panics. Confidence erosion spreads. If investors doubt lending to Washington for 3 months, they avoid 10- or 20-year bonds too. Long-term treasuries become toxic, making government spending harder to fund. Each Fed intervention adds liquidity, fueling inflation. The same inflation the Fed worked years to contain. Keeping short-term rates low during stress requires even more money creation, making inflation harder to control and everyday goods more expensive. Inflation is sticky. A second wave approaches. Inflation in the United States, well, it never really fully cooled. You can spot the signs everywhere. Coffee, bananas, bacon, all costing more than just a few months ago. Headline inflation is now back at 3%, up from 2% in April, and producer prices sit at 2.7%. That means businesses are paying more, which eventually gets passed on to consumers. When you adjust for these price increases, retail spending has actually fallen slightly, and consumer confidence has hit some pretty low points. Despite all these signals, the official messaging tends to downplay inflation. Tariffs are raising import costs even further, and if the Federal Reserve cuts rates in 2026, there's a real risk of fueling a second wave of inflation. A Fed influenced by Trump may be hesitant to tighten policy again, potentially accepting 3% as the new baseline, which honestly could lock in permanent pressure on household budgets. Rising costs are affecting food, transport, energy, and services. And once this new baseline is set, even bigger shocks can ripple through the economy. Monetary policy at this point begins shaping not just spending habits, but really the broader path of the entire economy. The Fed pivot, easy money is back. The clearest signal came from the Federal Reserve, which injected $13 billion into banks. That's the largest boost since 2020. Funding had become tight, especially with banks lending to artificial intelligence and data center projects. Then, the Fed ended quantitative tightening, or QT. Before, $100 billion a month was being drained from the system. Now, with QT over, there's roughly $2.5 trillion of excess liquidity circulating permanently. Before the pandemic, the Fed's balance sheet was under $4 trillion. Today, it's over $6.5 trillion. Without QT, all this money stays in the system, supporting bond issuance but, at the same time, increasing inflation risks. Every future policy decision will determine just where this liquidity flows next. The coming asset boom, dollar weakness, and global effects. Liquidity is already changing money flows. Money market funds, which are holding over $8 trillion and earning about 3.5%, could start redirecting funds as rates drop to 2% or even 1% in 2026. Trillions could flow into equities, Bitcoin, gold, and silver, potentially sparking a major asset boom. All this is happening amid rising inflation and higher living costs. Wealth inequality in the United States is now higher than in China or India. Inflation, combined with an asset surge, benefits owners, while those with little savings are left falling behind. The middle class is getting squeezed between higher costs and slow wage growth. Washington doesn't have many options. The Treasury needs buyers, AI investment continues, tariffs keep raising costs, and domestic manufacturing needs capital. So liquidity really has to stay in the system. The likely outcome? Gradual inflation will reduce debt pressure, the dollar will weaken, and asset prices will rise, shaping global markets in the process. The big question is, will the Fed aggressively cut rates in 2026, and just how far could the dollar fall if inflation stays higher for good? Share your thoughts below and, well, don't forget to like and subscribe. See you in the next one.